Good morning, everybody, and thank you for joining our webinar today. We will begin by quickly introducing our firm, ADI Analytics, and then dive into the topic of today's discussion. I will take 30 to 35 minutes to present our prepared materials, following which we will have a question and answer session. We plan on getting done within 45 minutes to an hour. We welcome your comments and questions during the presentation, which can be submitted on the right side of the screen. Very quickly, ADI Analytics is a boutique consulting firm based in Houston. We focus exclusively on oil and gas, energy and chemicals, and within these segments we work across the value chain. So for example, in the oil and gas industry, we work on exploration and production, midstream and refining, and gas monetization problems. Our firm has been around for more than 6 years, and over the past 6 years we have worked with over 70 clients for whom we have completed nearly a couple hundred projects. We have a pretty diverse client base that includes large oil and gas majors, E&P and refining independents, companies serving the oil and gas space with equipment and industrial services, energy-focused industrials, investors, technology startups, and government agencies. Gas monetization is an area where our firm brings particularly deep expertise. We have completed a number of consulting projects in a number of gas monetization options. This is also an area where our firm provides subscription-based research service that delivers monthly and quarterly reports and other deliverables that cover a wide range of gas monetization options, some of which are shown here. Our research coverage includes large-scale and small-scale LNG, the use of natural gas for power generation to displace both coal-fired power capacity as well as new plants. We've also done a lot of work and actively track markets that focus on converting natural gas through fuels using technologies such as gas to liquids and methanol to gasoline, as well as direct conversion of gas into chemicals such as methanol and ammonia. Finally, we are seeing increasing use of natural gas in the transportation and industrial markets, both of which are also active gas monetization market segments that our firm covers. Today's webcast is based on research that we have completed as part of our natural gas monetization research service, and we'll share highlights from the second quarter report that we have just completed. We like to do our presentations and our updates from our gas monetization research service around key messages, and today I'm hoping to leave all of you with 4 key messages. The first is a fairly obvious one, but is an important one and bears emphasizing, and it is that growing supply of cheap natural gas thanks to shale and unconventional resources and along with new regulations on flaring are playing an important role in the natural gas monetization market. This strong growth in supply of natural gas coupled with the relatively slow demand growth, which is the other part of the equation, is collectively leading to new investments, projects, and proposals all focused around the natural gas monetization market. You've probably seen a version of this slide a number of times, and it emphasizes how robust and how strongly natural gas supply has come along in North America thanks to shale and unconventional resources. In 2010, shale gas was less than 3% of total supply. Today it is more than 50%, and that is how it is projected to go forward through 2030, with shale and unconventional resources supplying more than 50% of total natural gas supply in the U.S. In addition to supply coming on in a very strong way, the nature of the supply is also evolving, and a lot of the supply is now is coming in a very distributed fashion from dozens of plays and tens of thousands of wells. And many of these wells are in areas that are not well connected with pipelines and other evacuation capacity. As a result, in some plays, natural gas flaring has been growing very significantly. Bakken is one example where more than a quarter of natural gas production was flared in 2013, and a similar number was also flared in 2014. As a result, states are getting increasingly concerned and have come up with a variety of regulations focused on reducing natural gas flaring across some of these plays. Interestingly, some of these regulations are coming up even in states that are that have been fairly friendly to the oil and gas industry. For example, Texas. In general, most of these regulations are focused on mitigating or reducing the amount of time that an oil and gas operator can flare natural gas for. So in general, most of these regulations focus on reducing or limiting the amount of time during which flaring can be permitted. In addition to supply, the other big component in the natural gas monetization market is demand, and in general, demand has been where the bottleneck has been. Demand for natural gas is not growing as fast as supply has, and in fact is growing far too slowly. If you take natural gas demand in the US and break it down into the four major segments, residential, commercial, industrial, and gas used for power, which is shown here, you will see that most of these segments are growing at a very slow pace. Until about a year back, most of these segments had virtually no growth at all, and it's only in the last couple of years that industrial and commercial demand growth has picked up. And until recently, the only bright spot in the demand picture was natural gas used for power generation. So collectively, there is a lot of supply, and the supply has been growing fairly strongly. But the bottleneck really has been demand. As you can see, demand for natural gas is growing far too slowly. When we break out natural gas demand into the four major segments, which is what we are showing on this particular page, residential, commercial, industrial, and gas used for power, you'll see that except in the last couple of years, in general, gas demand has been either stagnant or in some cases even declining. It's only in the last few years that we see demand in the industrial, commercial, and residential segments growing. And until recently, this growth rate was quite low as well. Gas used for power generation has been the only bright spot in the last few years as natural gas continued to displace coal-fired capacity for power generation. Coal-fired power capacity has been quite distressed, mainly because of regulatory pressure, and natural gas has essentially grown at its expense for power generation. Even so, collectively, natural gas demand has been growing far too slowly, creating a lot of opportunities for new technologies and new business models and new projects in the gas monetization space. And as a result, we see a number of new ideas being developed around a wide range of gas monetization options, collectively improving the gas monetization market's size, scope, depth, as well as maturity. As part of our natural gas monetization research service, ADI has inventoried over 100 projects across various natural gas monetization options and have assessed for their likelihood as well as capital spend. And based on that, we estimate that a little over $20 billion of capital investment is pouring into natural gas monetization projects across North America. Going forward, we think that this market will grow to as much as $26 billion by 2017. And this is based on projects that we have assessed as being the most likely in terms of their feasibility and in terms of being completed. You will see that the bulk of the capital project spend is going to large-scale LNG export projects, followed by projects that are focused on gas conversion into fuels and chemicals. But increasingly, there are fairly interesting projects that are being developed in a number of other areas. For example, small-scale LNG, as well as projects focused on monetizing natural gas that is being flared. That brings us to our second message, which is that LNG export projects, in particular large-scale LNG projects, offer the best economics, and as a result, we see a significant number of gas monetization projects being focused around LNG exports in the United States and Canada. One of the things that we do routinely as part of our natural gas monetization research service is to look at project economics and option economics. We are showing economics for gas monetization options on the Gulf Coast on this particular page, but we have looked at costs and economics of various projects across North America in different regions within North America as well. For a hypothetical project using 1 billion cubic feet per day of natural gas, if we look at LNG, methanol to gasoline, and gas to liquid options, you can see that LNG offers the best economic returns. On this particular chart, on the x-axis, we have a ratio of oil and gas prices on a barrel of oil equivalent basis. So if you take natural gas price and multiply that by 6, you will get the equivalent in terms of barrels of oil. So the most recent ratio is a little over 3, at which an LNG project could expect internal rates of return of about 15%, which is shown on the y-axis. If you're just looking at economics for a simple 10% return case, you would need a gas ratio of somewhere around 2.7 or so, and even in the depressed oil prices that we see right now, some of these gas monetization projects are reasonably competitive, and of course LNG export projects offer the best returns. As a result, there's been no dearth of LNG export projects. Our firm and its research service has identified over 40 LNG export projects in US and Canada, and we spend a lot of our time as part of the research service benchmarking the likelihood and feasibility of these project proposals. This particular chart shows an example of that project benchmarking, where on the x-axis we have shown the competitiveness of a project in terms of time to market, which is a function of where the project is across the regulatory life cycle, and what is the anticipated time for the project for securing various approvals, as well as construction and time to production. The y-axis shows project competitiveness, which is a function of capital cost and the ability of the project developers to have secured offtake contracts for the LNG production, and where they are in terms of securing customers who will be buying LNG from these projects. So when you evaluate all of these projects and benchmark them across these criteria, you will see that except for a handful of projects, most of them are relatively undifferentiated. The ones that are well positioned are the ones on the top right in the orange color. Some of these include the usual suspects like Cheniere's Sabine Pass, but there are some interesting projects as well, like Carib, for example, which is a fairly small project, but that has a pretty interesting business model focused on serving the Caribbean and the Central American economies with niche LNG supply deals. If we evaluate all the likely LNG export projects and assess their feasibility, and based on that we forecast the likelihood of LNG being exported, we are anticipating somewhere around 80 million tons per annum, or approximately 11 billion cubic feet per day of LNG exports by 2020. Of course, this assumes that most of the projects will stick to their timelines and will move forward. And at this point of time, it's only Carib that has really started operations, while most of the projects are still in the construction phase. The third key message that we'd like to leave with you this morning is around small-scale LNG, which is emerging as a fairly attractive monetization option, driven by the emergence of multiple end-use markets, as well as growing demand regionally from economies in the Caribbean and Central America. LNG is emerging as a credible alternative to diesel fuel in a number of transportation and high horsepower applications. So LNG could be used fairly economically in heavy-duty trucking, in the E&P segment to fuel oil field equipment, replacing heavy fuel oil and diesel in the marine segment, as well as rail and industrial market segments. We have spent a lot of time looking at the feasibility of LNG in each of these segments, including microeconomics, in particular the cost for an end user to switch from diesel to using LNG for their particular equipment or fleet of trucks, for example, as well as the cost differentials required for LNG to be competitive relative to diesel. Clearly, the adoption of LNG in each of these segments will vary significantly depending, again, on a particular segment's specific situation, but we have spent a little bit of time trying to understand and forecast what LNG adoption in each of these segments would look like. In addition to various end-use markets, there is a significant amount of pent-up demand for a cleaner fuel such as LNG in a lot of Caribbean and Central American nations, which projects based out of the US can serve fairly quickly and fairly competitively. We have identified a number of countries in the Caribbean and Central American regions that can be served with fairly easy regulatory approvals, as well as small-scale LNG projects that would not require very large amounts of investment. Now, having said that, there are risks, especially around regulatory approvals to a certain extent, but more so in terms of the ability to secure small-scale LNG capacity, as well as in terms of navigating the bureaucratic issues surrounding some of these Central American economies. Supply is certainly one of the issues in small-scale LNG. If you look at small-scale LNG plants across the US and evaluate them, you'll find that only a small share of capacity, less than 10% of small-scale LNG capacity, is available for non-power, non-peak shaving applications. Most of the LNG capacity is dedicated for peak shaving power generation applications, and it is difficult to source LNG from these plants. So if any of the market segments that we talked about, heavy-duty trucking, rail, marine, start picking up and start using significant and material volumes of LNG, the US would need additional small-scale LNG capacity. As a result, a number of projects have been floated, and we have analyzed over 40 different projects, all focused on small-scale LNG. And based on our analysis, we project that small-scale LNG capacity will grow by about 40% over the next 3 or 4 years. Now, clearly, some of these projects may not go forward, so this is based on our assessment of the projects that are most likely going to move forward. Even so, we see a lot of interest in small-scale LNG at this point of time, and as a quick commercial, our firm has just launched a new multi-client study that is focused on providing an in-depth assessment of the small-scale LNG market. That brings me to the final message that we want to leave with you today, which is around natural gas conversion to fuels and chemicals, which is another credible option for monetizing natural gas volumes, and where there has been considerable interest in both large-scale applications as well as small-scale applications. In the past, most of the attention on the small-scale side has focused on gas to liquids, but we are seeing new attention and interest from small-scale methanol plants, which is an area where we have done considerable work as part of our gas monetization research service. Now, as I mentioned, a number of large-scale methanol plants have been announced in North America over the last couple of years. Most of these plants are pretty capex intensive, with average capital costs in excess of $500 a ton. Interestingly, some of these capital projects, some of these methanol projects are focused on exporting methanol out of North America into Asia, in particular China, where a significant amount of methanol to olefins capacity is coming up or has already been established. So essentially, this is another way to export natural gas, where you're essentially converting it into methanol and shipping methanol, which is much more easier to ship than, say, LNG, into some of the Asian economies. Now, in comparison to large-scale methanol plants, small-scale methanol plants offer the potential of playing in gas monetization markets at a lower level of investment. However, on a normalized basis, capital costs for small-scale methanol plants are much higher, ranging anywhere from $700 to $1,100 a ton, as we show on this particular page. In addition to that, if you assume a variation of anywhere from a couple dollars to as much as $5 in the cost of natural gas feedstock for methanol plants, and assuming a capacity of 50 tons per day and a gas feed rate of 36 million BTU per ton of methanol product, and making some other fairly straightforward assumptions, we can assess economics of small-scale methanol plants, which is shown on this particular page. This chart shows the price of, or the cost of natural gas feedstock for the methanol plants on the x-axis, and methanol cash costs, or break-even costs, if you will, in order to deliver that 10% return that we assumed earlier. We see what cash costs are at different levels of capital cost investment. You will see that cash costs range anywhere from a little over a couple $100 per ton to as much as $350, $400 per ton. Now, if you layer on top of this historical methanol prices, you will see that in general, the cash costs from small-scale methanol plants are above the 10-year minimum methanol price of about $170 a ton. So if one thinks that methanol prices may fall to as low as $170 a ton, you could disadvantage and put some of these small-scale methanol plants in a difficult situation. But if one believes that going forward, the average methanol price will be around the 10-year average of a little less than $450 a ton, most of these small-scale methanol plants will be competitive and should deliver more than the assumed financial returns of 10% that we assumed earlier. There are a couple of risks with small-scale methanol plants, one of which is technology risk. There is no commercially proven small-scale methanol technology that is available yet. There are a number of companies that are developing technologies in this space, including established players like Air Liquide, which has historically focused on large-scale methanol plants, to a number of early-stage technology startups that are trying to develop and commercialize small-scale methanol technologies. In addition to the technology risk, there's the market risk associated with trying to find customers for small volumes of methanol, as well as trying to be competitive with the large-scale methanol plants who could potentially ship methanol into different parts of North America. In summary, these are the four key messages that we were hoping to leave with you today. First, growing supply of cheap natural gas, along with new regulations on flaring, is making available natural gas supply in a very strong way, and that, coupled with the relatively slower demand and growth, is driving interest in a number of gas monetization options. Large-scale LNG export projects continue to offer the best economics in terms of all the gas monetization options that are available, which is why you see a number of planned projects coming across North America. We think that only a handful of these are best positioned to move forward, collectively positioning the U.S. to ship as much as 11 billion cubic feet per day of natural gas as LNG. Small-scale LNG is another attractive monetization option, especially with multiple end-use segments, including heavy-duty trucking and marine. And that, coupled with pent-up demand for cleaner fuels, especially in the Caribbean and Central America, could drive a resurgence in small-scale LNG markets. Finally, natural gas conversion to fuels and chemicals continues to be a credible option, with a number of projects, both at the large scale as well as small scale, having been proposed. Of late, there's new interest in small scale GTL and methanol plants, which continue to offer the promise of fairly competitive returns, even at the small scales. We hope that this webinar was helpful and provided you with insights into the natural gas monetization markets. We have a wealth of material that is available on our website, in addition to information about our gas monetization research service, as well as a blog that we publish regularly. We welcome you to visit us and reach out to us if we can share more information on any of these issues.